I'm sometimes asked, what rate of return can I expect to get on my investments? Well, year to year I don't know, but I would expect that over time you would get a rate of return that's very similar to what the market has given in the past. So let's look at this chart, and this shows the actual rates of return from the Toronto Stock Exchange. And the way to read this, if somebody invested in 1980, they would have earned an average of 30%. Now if that person had held on to that investment to 2008, they would have earned an average rate of return of 8.6% every year. Okay, and we can see over time these would be the average rates of return that they would have earned. Okay, so mostly 8s, some 7s. So we'll probably say an 8 to 7% rate of return on equities since 1980. And just to give you an example, if somebody invested in 1990, the average rate of return, if they held to today, would have been 6.8%. Okay, and if we scroll this way, we'll go back as far as we have data to 1957. We can see the average rate of return has been 8.99. Mostly 9s and 8s. Okay, I want to look from 1957 because I'm going to compare this to bonds in a minute. We can see if somebody invested in 1957, it would have lost 20% right off the bat. And if we go to 1980, they would have earned an average rate of return of 10%. The other interesting thing to look at is if you do lose money, how many years does it take to recover that? Okay, so if we could draw a line coming down to 5 years, we can see 1969, there was a time when it took more than 5 years to recover your money. Okay, but there were some good years in between, which we could have drawn some profit for those retiring. But we can see going down 5 years, in most cases, markets would have recovered. Okay, so let's go and let's just now take a look at bonds. So here are the rates of return that we see on bonds. And again, if we look at 1957, and let's go down to 1980, so we can do our comparison to stocks, we can see here that the average rate of return on bonds would have been 4.8%. So we can see over that time period, you were better off by more than double to invest in stocks. Okay, and of course, if you held from 1957 on to 2008, you would have earned an average rate of return of 8.4%. We can see the long-term rates of return on bonds have been 7s to 8s. Okay. The interesting thing, though, is if we come short-term and look at 1980, we can see the average rate of return from somebody investing in 1980 was 11.2%, whereas only around 10%, I believe, if somebody invested in stocks. Actually, it was 8%. Okay, so you would have been better off investing in bonds, and we can see that long-term, or since 1980, bond returns have been very, very good. Okay, hardly any years of negative numbers, and recovery was quick if you lost money. As a matter of fact, you recovered the following year. If we go out, we can see that there were some years investing in bonds where it did take some time to recover. But the main difference between this time horizon and the time horizon down here where things were very good were interest rates. Really, when bond returns weren't that great, we had before 1980 we had increasing interest rates, and since 1980 we had decreasing interest rates, which is very good for bonds. So long term, you do hear that stocks always beat bonds, but we just have seen a case here where over a 30-year time frame, bonds actually beat stocks. But again, that was because interest rates were decreasing.